folks. It's Dave Burrows. I want to welcome you to our Tuesday Barometer Readings webcast. We're going to talk a little bit about markets today. We're going to talk a little bit about earnings. We're going to talk a little bit about some of the news flow and bumpiness. I've also asked a guest to come on to talk a little bit about some of the alternative income stuff that we're trying to do that's been working out quite well. And so without any further ado, I'm going to jump in. And let's just talk about kind of what's going on. Obviously, markets have been choppy, but if you look at it in a broader perspective, not so choppy. These are monthly bars going back to the beginning of January last year. So far for the month of February, down about 1.12%. And we're trading very close to where the highs were. Now, easy to say, when we looked at it last week, the S&P had just broken out of a range that had been in, going back to the end of December. But interestingly enough, it very quickly failed. So this is, part of the news flow that we're going to get. We're getting sort of Trump bombs from time to time, and that's impacting investor sentiment for sure. We talked last week about the fact that individual investors are fairly bearish and cautious. There has been some cash raised for sure. So what I want to do this week is kind of look inside the market, see what evidence we have of weakness. There certainly are things that are doing okay, and there's certainly some things that are having a harder time. And our job as the manager is to try and make sure that we stay focused in parts of the market people care about, be disciplined, stock by stock, sector by sector, to make changes as they're required. Because, at the end of the day, the portfolio has to make sense given the environment that we're operating in. And part of the reason I do these weekly calls is because it helps me to know that I've got to put up on the screen, what we've been doing, show a report card, and talk about what might need to change. So as I discussed last week, lots of individual investors are bearish. Part of that has to do with the fact that the market's been doing well. And so people get concerned that if the market's been doing well, it must be time for some difficulty. But part of it, I think, is concern around policies coming out of the new administration in the US. Frankly, there are some things to be optimistic about. There's some things to be concerned about. There's uncertainties. We highlighted last week that when you look at monthly seasonality for a new presidential cycle year, February tends to be a negative one. So we're down a little less than this right now. We're at the 25th of February. It's not unusual for some bumpiness. We've talked about, post-election historical price behavior. This is looking at it another way. There tends to be some sloppiness leading out through the first 100 days. But it tends to be that by the time you get to March and April and May, odds of success are higher than they are in February on the way in. So when we look at the NASDAQ 100, it's the same picture. Broke out of the range last week, but very quickly failed. So we're trading below the 50-day moving average. The NASDAQ 100 has been underperforming the S&P for some time, and it's something that we want to keep an eye on. So it's important to recognize valuation, but it's really hard to make decisions based on it. So if you pull back the lens and say, are US stocks expensive? Yes, they're expensive. You got 10 stocks make up 30% of the S&P 500, and they're not cheap stocks. When you look at relative valuation, price to book versus where we were at the end of the 90s, it's not inexpensive. And that's part of the reason that we've spent time talking about where we want to target and what we want to avoid. When we look outside of the US, we've talked about this for some time. Global stocks are quite interesting. You got markets like Japan. Now, off the top, I always talk about how when you go through long periods of years without the market making a new high and ultimately you start making a new high, it generally means that's the beginning of a long-term bull market. And we've talked about Japan for some time. Last week, we talked a little bit about Europe. This is the Euro Stoxx 50. The beginning of this box is 2008. The end of this box is 2023. We broke out, went through a tightening cycle, and this is the last 3 months. Europe is blasting off. Now, if you were just reading the news about some of the things that are going on in Ukraine and some of the discussions we've had around tariffs, you would think that European stocks would be in a tough spot. But frankly, part of it is the makeup of European markets. And the biggest sector by a long shot is financials. And financials have been a strong performing sector. Interestingly, we've just had the best 4-week period of inflows into European stocks in the last 3 years. Now, outside of Europe and outside of Asia, we've seen strength in some of the Latin American countries. Again, has to do with the sector weights, energy and materials here, and also financials. But when we look at Europe, despite the fact that the Euro Stoxx 300 is making new highs, sentiment isn't great. So individual investors are the same everywhere. They read the news. And when they're reading the news and there's a lot of things on the surface to worry about, it can sometimes cause them to look beyond the fundamentals. Now, the fact is, financial services companies around the world over the last 15 years have been rebuilding their balance sheets. They've been rebuilding their systems. They've been adding technology. We now are in a world where the spread between short-term rates and long-term rates is significant. They can actually make a net interest margin on their loan books. And frankly, also businesses in general getting better. This from the World Bank, percentage of major manufacturing PMIs that are in expansion, and it's expanding. When we look at the cyclical stock price behavior, frankly, European cyclicals are doing better than US cyclicals. Now, we've spent some time over the last year talking about the idea of building in a global component, ex-North America. And I think that that's really important. We talked last week about the returns so far year to date, US being a long way down the list. Now, frankly, it's further down the list today than it was a week ago. So there's other things to do, despite the fact that we're all concerned about tariffs and geopolitical risks. Frankly, I think this is an interesting picture. This is the TSX. So a lot like global stocks, came out of a bear market in 2020, went sideways while the global central banks tightened, but monthly has been marching its way higher. Doesn't look much like panic here to do with tariffs. Now, there's certainly companies and sectors that are more vulnerable than others. But given the discussion that I see and hear from people and their worries about, what's going to happen going forward, the market's taking it very much in stride. Frankly, if I compare the TSX against the S&P 500, the S&P outperformed, the TSX underperformed from 2008 until recently. Now, you had the first sign of it in 2022. Then we went through the tightening cycle. And now it's strengthening again. So since last June, the TSX, including up to now, this second before we started the presentation, is outperforming the S&P since last June. And again, that has to do with the sector exposures that have an impact on the market. US, very tech-centric, very consumer-centric. Tech has not been doing that well. And on the other side, Canada, very heavily focused in financials. And our financial services companies doing pretty well. Now, we've highlighted this before, but TSX relative to the S&P is darn cheap. So there's a lot of bad news has been discounted into the Canadian market. A lot of poor decision-making at the government level and a lot of policy not so friendly to business. You have to remember that the news is news today. Valuations in companies are built over years. So, we keep an eye on US stocks relative to the rest of the world because free cash flow yield or the price of stocks versus their free cash flow makes them more expensive. And we're quite interested in focusing in parts of the world where there are, more financials and energy and industrials. Even frankly, China is behaving a whole lot better, and that's something to keep an eye on. So we've talked before about how when global stocks start to do well after a long period of US stock outperformance, can make a big difference. Since we started our global fund, it's way outperforming the global indices, and it's because there's a lot of great companies in there, and MSCI All World Index has only just started leading the equally weighted S&P 500. So moving on to fixed income, we've had significant bond yield lows in 2020. We've had a really tough bond market. Yields have been working their way higher. Yields came down a little over the course of the week. Long-term bonds popped up a little bit, but still trading below all of the moving averages. We're still in a bond bear market until something changes. Now, if they actually can really cut some expenses in the US government and cut the spending, well, the bond market might start to like that. But frankly, we're still driven by the inflation cycle and interest rates. And after a first move higher in inflation, as we've seen in these historical cycles, you tend to have a second wave. And we think that that's likely. As it stands, we prefer stocks relative to bonds. They're upwards and to the right. We prefer dividend growth stocks versus bonds for our income investors. It's upward and to the right. Outperformance one versus the other. And despite the fact that the market's been a little sloppy, if I look at the point and figure price charts of the RDVY dividend growth ETF, it's higher highs and higher lows. That's exactly what we want to see. So the RDVY continues to trade above all the long-term moving averages. It's pulled back a snip off the highs. But this is, I think, where we're going to get returned. Now, in our income portfolio, we can own any kind of cash generating asset. The goal is to buy securities that have fundamentals that are good to begin with, but are getting better. So the market may be willing to pay a higher multiple of earnings or pay a price that reflects a lower credit spread. And we want to own things that can pay us more over time. And it's been working. Over the last couple of years, aggregate bond index up 5.8%, the investment grade corporate bond total return just over 9%. The dividend aristocrats index up 21%, income portfolio up 35%. So it's been a really good go. And one of the things we've been trying to do is build in alternative sources of income. So I've asked Jeff Spottle to jump on the call today. One of the things that we hold in our income pool is a weighting in our global music royalties fund, about a 10% weight. Of course, we have it in many of our client portfolios. A lot of clients don't have it because they haven't chosen to enter. We're going to do a webcast next Wednesday at 4:00 specifically on this, but I just wanted Jeff to come on and just give us a little bit of some of the highlights as to why this has been working and why it's been complementary. And frankly, in a week where there's lots of people concerned with market risk, why it helps us sleep at night.
Hi, David. Thanks for the intro. Hello, everyone. So at Barometer, we started investing in music royalties 6-7 years ago. So we've learned a lot over the 6 or 7 years, and the space has really matured. And what we're finding is that we're getting a nice combination of predictable, consistent yield, while also experiencing appreciation within the portfolio. So it's been a nice blend of growth and income. So we just highlighted a couple of slides. So what we're focusing on is buying music copyrights almost entirely from co-writers and co-collaborators who work with the big artists, most of whom are Canadian based, but it's not exclusive for our fund. It's just where our network is. We've partnered with a team called Kilometer Music Group, led by a guy named Michael McCarty. And Michael has been a publisher his whole life. He was the president of EMI Canada. He's worked with Michael Jackson, CBS Records. He has a long history, worked with Ontario Teachers Pension. And he's going to be our guest speaker next week to go through royalties in more detail. But Dave just asked me to highlight on a few things. And what we're focusing on these copyrights are the biggest songs, the top 40, the trophy assets, because they're the ones that are the most enduring. They're the ones that are locked into pop culture, and they're the songs that will have the longest legs of paying out. And we've done a great job. You can see of the top 10 most streamed artists in history, we own songs or co-own songs of 8 of the 10. Taylor Swift is number one, no surprise, closely followed by Drake, as number two. You can see how many songs we have. We actually had 2 of the songs that were in Taylor Swift's tour that she did recently, which grossed over $1 billion. And we owned 2 of the 30 songs that she played in her song list. So that was one of the ways we made money. And not only is it a good investment, it's actually one of the more interesting things to talk about when clients are looking into it. And I think you'll find next week quite interesting when Michael gets into it.
Now, Jeff, just to be clear, the focus has been on purchasing the copyrights, the songwriter's copyrights, as opposed to the performance rights. So anytime this song gets used currently and into the future for, what is it, 70 years plus the life of the last remaining artist,
That's right. So yeah, 70 years.
anybody re-records it, they pay the royalties on it as well.
That's right. So there's 2 parts of it. One part of the royalty gets paid to the co-writers, and one part gets to the master recording. So if you were there at the recording, be a singer, a musician, the person who is the producer, you get paid on the master. If you were one of the collaborators who wrote it, you wrote the beat, you wrote the lyrics, you wrote the melody, you would participate in the copyright. And often the artist will participate in both. So from a return standpoint, the slide that's up right now, the top line, the distributions, these are actual cash distributions that we've paid out to investors. So you can see the growth year over year, and that's partly due to the fact that we're in an inflationary environment. So royalties are calculated on gross revenue. So as radio stations charge more for advertising, as Spotify charges more for their monthly subscription, it's gone from $9.99 to $10.99 a month. As concert tickets go up in price, so do our royalty participations. So we are growing year over year because we're in an expanding environment for royalties right now. And you can see that last year we were well over 9% paid out. It's also a very tax efficient payout. It's a tax as a return of capital, which prolongs the tax implication and turns it into a capital gain on exit. So clients get the full use of that cash flow.
So Jeff, just talk quickly about how the revenue line can grow.
So the biggest thing that's changed the investment world for music is digitization. We've moved from a one-time purchase of a record or CD to the ongoing streaming. So with streaming, for the price of 3 or 4 or 5 records a year, you can get access to every song that's available through streaming. So it's way more efficient for the client, and it's this consistent revenue flow for the artists. And you can see by the yellow line that the prolific growth on streaming is well outpacing the dark gray, which is the physical sales. So this is a forecast going into the future, but this is where we are, kind of where the streaming is. It's really outpacing where we were on physical sales.
So Jeff, we're getting our cash flows, and that's great. But then there is the value of the portfolios themselves. And, because we've been able to purchase these catalogs well, and because we've aggregated a significant catalog, I think it's just about $160 million worth of catalogs. And because prices for the catalog has been going up, ultimately there's a good chance at pretty good capital appreciation. I mean, we've had some small write-ups in valuation per year, which has added up to a total return that's been pretty darn good. But maybe just talk quickly about how the fund is valued versus what's happening in the marketplace.
So the back of the envelope math is that investors will pay a multiple of the next year's earnings. And that multiple has peaked as high as 20 times. If you can see that sort of in 2019 going into 2020, with rising interest rates, it's settled down a bit, but sort of in that 16, 17 times multiple is what catalogs will sell for. Now, premium catalogs like, I don't know, Queen or Michael Jackson, they'll command, a much higher multiple, but the blended average is around 16. Now, that's why we're going after the premium catalogs. Now, our catalog average at acquisition has been 11.4. So we're very confident that we are going to be able to sell at a 15, 16, 17 times multiple when it comes time to sell our catalogs. Part of the reason we bought at a lower multiple is we're dealing with smaller co-writers of songs and Canadian typically, and also size. We're competing against, billion-dollar funds, and yet we're buying $2, $3, $5, $10 million catalogs. Not everyone is competing on the smaller catalogs like we are.
Well, it's pretty interesting, and maybe we'll spend a little bit more time. We're going to do this call next Wednesday. We're going to invite Michael McCarty on. He's the only producer in the Canadian Songwriters Hall of Fame, and it'll be an interesting call. But this has been really additive to the strategy, and we found it to be pretty additive to client portfolios and trying to find alternate sources of income along the way. Thanks so much for jumping on, Jeff.
My pleasure.
Just quickly, we'll move on. Commodities continue as far as asset class goes to march their way higher. They pulled a little bit back off the highs over the last week. Frankly, gold is trading very close to highs and is trading about 45% above the long-term moving average. We've talked about over the last little while that there were no flows happening. In other words, central banks were buyers, but individual investors and fund managers were not. That's starting to change. In the most recent period, we had just about $5 billion come into the GLD ETF. That's after significantly no flows over the last number of months. We do think that these things can go a fair ways higher. Historically speaking, bull rallies in a bull market have gone anywhere from 80 to 100% above the moving average. We're about 44% right now. And gold has proven to be a very stable asset, another diversifier over the course of the last couple of weeks. Market's been sloppy. Even gold stocks have pulled back, but gold itself has been rock solid. We think that this can go on for some time. The big reason is that when you go through a bear market, capital spending falls and finding new gold falls. And we've been through a significant bear market since 2010. The spending to find new gold deposits has dropped off, and the finding new gold deposits exceedingly low. And of course, once you find them, you got to put them into production, and we think that that's going to take some time. Copper is very similar. We talked about that. There've been very little by way of new copper discoveries. Copper's perked up in the last little bit, and especially important with PMI data turning up, there is a high correlation between commodity prices and PMI data. And so as activity picks up, commodity prices should pick up, and certainly, it's an inflation-oriented asset. So given a choice, we'd rather own commodities versus bonds. And frankly, over the last couple of weeks, last couple of months, commodities relative to stocks. So this is an asset class that's not going away. It had a long period of underperformance. Frankly, commodities have been outperforming the equally weighted S&P since 2022. And we think that could go on for a long time. US dollar continues to back off. That's, I think, helpful for global markets and for commodities in general. Canadian dollars holding that low that it put in a couple of weeks ago. So at the end of the day, we don't have to be everywhere. We got to pick our spots. We're working really hard at taking all of the neighborhoods that we could focus in to identify as those that are seeing net inflows of capital. I mean, really, the goal is to try and focus in neighborhoods that are productive and seeing new money get put to work. On the bottom up side, we're looking for securities with great earnings, good balance sheets, but where something's changing for the better, that can lead to revaluation or outperformance in the market, and where we can find those companies that meet those tests in parts of the market that matter, this is where our portfolio is going to live. Now, relevant right now, when markets have been doing well, often at some point when things start to change, you'll get certain sectors start to roll over early. And stocks within those sectors start to roll over. It may be the leading stocks continue to perform well, but if there's enough deterioration in breadth, or if the market narrows enough, ultimately you can wind up in a difficult situation. And so when we start to get into sloppy markets, this is where we earn our money. If we have 30 positions in a portfolio, we'd love to think they're all going to work, but there's times when some of them aren't going to work, or when we go through a shift in the market that starts to impact one sector or certain types of businesses. And so we want to recognize it. When bread starts to deteriorate, we got to act a little bit differently, right? We've got to raise a little bit of cash. We've got to tighten up the stop losses that we use on all of our positions. And we never know which ones are going to be the ones that ultimately have to be managed out of the portfolio. But if they hit our stops, they got to go. Because the most important thing when we get into a sloppy market isn't the first 2 or 3 weeks. It's in week 8, 9, 10, when things really get difficult. We want to make sure, one, we've got some cash to protect us. And two, if it's a short-term issue and things start to get better, we need to have money to put to work at those prices. And so playing defense when things get difficult is really important, and it's an iterative process. We're reevaluating every position every day to say, does it continue to act the way it's supposed to in the market? Are the fundamentals continuing to get better? Is the sector continuing to be supportive? And if the answer is no, we got to be prepared to go to the sidelines. So when we look at the breadth data that we track all day, every day, you can see that in the US, percent of stocks above the 50-day, percent of stocks with positive weekly momentum, the percent of stocks making new highs versus new lows, and the percent of stocks trading above the 150-day or 30-week moving average, all have weakened over the last short while. Now, those are shorter term indicators, and I care. The big picture indicator, percent of stocks in uptrends, has held up, so that's a positive. But given the fact it's about 50%, it means that 50% of stocks are in uptrends and 50% of stocks are in downtrends. So what does that mean to me? It means we don't want to look like the index. It means that we want to be focused in strength. And it means we want to be careful not to get caught in weakness. Global breadth also is strong. So we've talked about global stocks and they continue to perform well. If I look at the S&P, the percent of stocks trading above their 200-day moving average, it's come down since December. So about 60% of stocks above their 200-day moving average. That means 40% are below. It means we don't want to look like the index. Now, interestingly, this year, there's more stocks outperforming the index than over the last 2. And part of that has to do with leadership, right? There's leadership in the market that is not the top 7 stocks. There's opportunity to generate return in other parts of the market. Now, we've talked about this for a long time. Financials continue to be leadership. Why is it that financials are doing well? Well, for one, the backdrop is a rising spread between short-term rates and long-term rates, meaning the lender can make money lending money. It's also that there may be some deregulation. It's also that inflation means asset prices expand and the risk of loss goes down. But frankly, against the sloppy market, the XLF looks pretty darn good. The XLF is the diversified financials ETF, owning everything from property and casualty companies like Berkshire to banks like JP Morgan to Visa and MasterCard. Diversified financials. This blue line, relative strength, rising from the lower left to the upper right. means that financials continue to gain strength relative to the market. Now, it doesn't mean that in uptrends, things don't pull back a little bit. Our job is to determine whether something pulling back is changing trend or just a normal pullback, which happens all the time. Interestingly, the interest in financials is expanding beyond the US around the world. We're having a huge rally in financial services stocks in Europe. Look at this move higher in relative strength. Frankly, if you take the lens back and look at it, European financials are breaking out for the first time, going back all the way to 2008. So we've talked a little bit about Fairfax, and Fairfax continues to perform really, really well. Frankly, if I looked at Berkshire Hathaway, it looks similar, but Fairfax is growing faster. It's got a lower valuation, and they've got a very high quality asset base generating lots of interest and dividends. The equal weight Canadian banks, the way that we've heard people talk about tariffs, you'd think that they're going off a cliff, but frankly, relative strength remains quite strong. And the earnings reports that we've been seeing coming in so far, coming in pretty well. I've asked Brian McNichol to jump on this week just to talk quickly about what we've seen so far in earnings, and talk a little bit about, you know, what we're going to be watching in the earnings reports from the Canadian banks over the next week or so. Welcome,
Perfect.
Brian.
So yeah, overall, we expect the quarter to show positive earnings momentum, and we got a glimpse of that this morning with the positive print from both BMO and Scotiabank. It's definitely an important quarter for the banks. So we're going to look for commentary on how they're positioning their provisions for credit losses ahead of potential tariffs from the U.S. and, of course, their overall view on the economic prospects for the country. Just quickly, provisions for credit losses. It's an accounting estimate just for potential loan losses. It's treated as an expense, so it does impact the bottom line if that number does go up. And it's a key metric just to ensure that they have enough reserves, in case we see some defaults from their customers. Current credit guidance for the year is pretty stable relative to 2024. With the trade war, it does present a material risk to the economy, and we don't necessarily expect banks to book higher provisions this quarter, but the probability in future quarters has increased if unstable conditions, remain in place. As such, we expect banks to inject greater conservatism into their credit guidance. We do note that the probability of massive builds like the ones that we saw during the pandemic is very low, but we're already seeing some evidence of the build. So both BMO and Scotia, they reported an uptick in provisions for Canadian loan losses. And the same goes for loan growth. Banks originally were very optimistic heading into the year, but the tone could become more conservative just as credit demand from retail and commercial borrowers is impacted by economic uncertainty in the country. On a positive note for the quarter, the pickup in volatility we're seeing in the market, it's a big positive for the capital markets business. That's going to benefit from banks such as Royal or National Bank, and Q1 tends to be a seasonally strong period for this segment. So Scotia, they put up a really great quarter from their capital market segment, and that provides a nice read through for the rest of the space.
So Brian, we've pared back our Canadian banks. We're really just focused in Commerce and RBC at this point, partly because we want to manage exposure. But RBC's actually hung in very, very well. Relative strength continues to rise, pulled back a little bit, but certainly, above trend. What are you expecting out of RBC when they report in a couple of days?
Well, I mean, the capital markets, it's about a quarter of the business, just given what we saw from Scotia, and we're going to get another read through tomorrow with National Bank earnings. That could provide some upward risk on the name, if you will. They offer a really nice balance of U.S. and Canadian earnings, about 51% coming from the U.S., a good chunk of that from the capital markets business. And they're right smack in the middle in terms of dividend growth with respect to their peers. So it's a great name to own. It's a really well-run bank.
Yeah. So the banks in general, whether they've been in Canada or the US or overseas, are all generating pretty good cash flow. They all have rock solid balance sheets. They're all generating dividend growth. So our job is to be diversified and manage our way through this, and along the way we'll continue to get presented with new opportunities. Actually, we just added some exposure to Intact Financial recently this week. You can see there was a dip here. They did there was a secondary offering of shares that got us into stock, and and it's trading at new relative strength highs. So things look pretty good there. And then Brian, also, you guys have done a great job with this TMX group. The exchanges continue to perform well. Boy, TMX trading basically at a 52-week high and making a new relative strength high versus the market. So think it's quite interesting, and we'll look forward to hearing your outlook once we get the RBC and the commerce earnings. Thanks for jumping in. So financials continue to be relatively underweight in institutional portfolios. After so many years of underperformance, portfolio managers have been slow to come back. We think that's a positive. And certainly, you know, when you see them hang in the way they have against a sloppy market, we think that that's a real positive as well. Moving on, industrials, they've been sort of consolidating since November. They're about 6.5% off the highs. This is the equally weighted industrials ETF. And again, you know, we have to assess whether a little pullback is something that's going to turn into a bigger one. When we look at our big holdings, you know, Howmet continues to perform really well on a relative basis, pulled back a little bit over the last week. You can see trading above all the moving averages. Same for Deere. We talked a little bit about Deere last week. It spiked higher, pulled back a little bit, but again, higher highs and higher lows, exactly what we'd want to see. Embriar is the same thing. Relative strength continuing to firm up versus the market. But not all of them are perfect. We got stopped out of GE Vernova this week. And, you know, James and I spent a bunch of time talking about this, but a company that has generated some nice returns for us. But frankly, you know, the nature of the stock is changing. Now, part of it is this is one of the sort of great growth stocks in the US over the last year. Growth stocks in general are the ones that are under pressure. You can see the relative strength line peaked out, pulled back, and really has started to break down. So when we broke support here, we had to move to the sidelines. You know, our job is to make sure a little mistake doesn't turn into a big one. And part of them is stepping aside and making sure we've got dry powder for when the time comes. So few positions that we're managing. But in general, you know, I think the sector exposure is continuing to work. Energy continued to chop its way sideways. We are into a seasonally strong period. We've been really pleased with what's happening with the gas producers, ARC Resources and Tourmaline. Suncor has continued to hang in really, really nicely. The energy infrastructure companies are hanging in nicely. I think CNQ is one that I'm a little bit worried about, just because CNQ does not have its own refining capacity. And so crude has to go to the US for refining, which means that they are at some risk on tariffs. So we're going to have to see there. When we get to materials, after pulling back in December, materials have been quite strong so far year to date. The golds are acting particularly well, relative strength, basically relative strength new highs. We think it's early days for the gold producers. Alamos reported a great earnings report and nice increase in their reserves in the ground. Wheaton Precious Metals is another newer position for us. Nice dividend payer with nice dividend growth, mid-teens dividend growth, and a royalty producer. So these companies are benefiting from the fact that, yes, the costs are going up to produce, but the price of gold is going up faster. And the cash margins are significant. And these companies are paying down debt and putting cash in the bank, buying back shares, returning capital to shareholders by way of dividend increases. And they're cheap on a relative basis versus history. Along the same lines as GE Vernova, we lost Cameco this week. That was a tough one. We do think that the future for nuclear is strong. It may be that the news flow is weighing on the stock, but we have to limit downside. The long-term picture for Cameco, I think, is great. It only just broke out of a range that it's been in going back to 2007. And it may be that this will turn around quickly and repair itself. But we're now trading below the 200-day moving average and below the shorter-term moving averages. Relative strength really weakened over the last couple of months, and we have to draw a line in the sand. So disappointed on that one. But again, it means that we've got a little bit of cash in portfolios. Moving on, communications continue to be very strong. A little bit of a pullback in Meta and Netflix, neither one breaking trend in any way whatsoever. Technology continuing to be sloppy. We actually saw some pretty significant flows out of technology over the last couple of weeks. And as I was concerned about, this is an ETF made up of the Magnificent Seven. The peak was in December, and it has gone through a period of weakness, and then over the last 3 days, really broken down. Only last week, we talked about the fact that the Mag 7's earnings growth has been deteriorating while the rest of the market's earnings growth has been improving, and there have been underperforming. So this has been a group that we've really been avoiding. In particular, semiconductors, they continue to be sloppy. Tomorrow is Judgment Day. NVIDIA reports their earnings tomorrow. We stepped aside from NVIDIA a while ago. I don't like seeing a group come into a weak period in the market on the wrong foot. And I was talking to clients today about the fact that yes, some stocks have pulled back over the last week, most of them just within trend. But when you get a little bit of weakness in the market, generally the weaker groups get hit harder. And the SOX, or the semiconductor index, closed near new lows today. And frankly, it's just going along with what's happening in growth stocks. Growth stocks in particular have had a difficult couple of months, and you can see it in relative strength. So outside of these groups, not a lot happening with utilities. They continue to kind of underperform. One thing we've noted this week is consumer staples started to outperform consumer discretionary stocks. As you know, we've kept a low weight in consumer discretionary stocks, thinking that that was one cohort that might have some difficulty with higher rates. In the big picture, gold continues its reversal versus semiconductors. Gold outperformed from 2002 to 2011. And of course, semiconductors have been champions over the last decade. But while this relationship is reversing, we've seen some steady technical improvement under the surface in the relationship between gold and semiconductors. And frankly, gold relative to the NASDAQ 100 in both cases. Gold has been outperforming the NASDAQ 100 since 2022 now. And we think that this is early stage. So just to cycle up, if we look at the sector distributions, the strongest sectors in the market continue to be financials. Precious metals are moving to the right. And on the left, we've seen some groups reverse down: machinery and transports. Those are more cyclical, more industrial focused. We make note of that. You know, as I mentioned, we did lose GE Vernova this week, which is in this group. Stock broke down. It's a mixed market. There are some strong sectors and there are some weak sectors. Things we want to keep in mind. The inflation expectations are jumped now to almost 30-year highs. Our focus has been focusing on owning things that do well during inflation. It takes a long time for people's expectations to change. And when they start to change, it takes even longer for people to reposition their portfolios to get ready for it. If you look at the portfolio weights, our biggest weight has been financials for over a year, and it's a significant overweight versus market. Energy is an overweight, industrials are an equal weight, materials are an overweight. All of these are sectors that benefit in an inflationary world. Technology, which is 28% of the S&P, is now only 6% of Barometer portfolios. Communications is about 6%. And when we move down into the defensive, staples is a relatively small underweight. Healthcare is a small weight. Real estate's a small weight. Utilities and bonds, all of these things do well in disinflation. We have to keep in mind, we are seeing inflation elevate at a time when we are getting global easing. easing into an inflationary environment may be a difficult prospect. When we look at monetary policy versus PMI data, when you get easing, you tend to get stronger PMIs, and stronger PMIs are good for materials, energy, industrials, and financials. When we circled up on earnings recently, we highlighted that earnings came in up 12% as of a couple of weeks ago. If you actually come to the end of the quarter with 425 companies reported, earnings growth has come in at just under 16%. So this is the best quarter we've seen since the second quarter of 22, and the expectation is for earnings to continue to improve. Within the S&P, financials generated 30% earnings growth. In fact, if you looked at all of the things that impacted earnings, financials accounted for 3.4% of the earnings growth. This has been the biggest contributor. So some risk metrics. Credit risk does not appear to be getting elevated, continues to be muted. Volatility is sitting solidly within the range that we've seen. We've seen some sloppiness in breadth, so we do have a little bit of cash. We've got about 6% cash in portfolios. But frankly, our holdings are hanging in really well. So the S&P is off 1% for the month. On average, S&P was down 1.6% in the month of February. In the first year of a presidential cycle, there's uncertainty. We have to see how things unfold. And remember this data point: when the market was up 3% or more on Valentine's Day since 1950, the rest of the year was pretty green. So look, we're going to manage positions one by one. And if things get difficult, we will get defensive. But I think that we're still sort of on the right path. And we'll just continue to add new information into the hopper each week, reconsider our positions, and move forward. So with that, if there's any questions, let's see what we got. Okay. I just sat through a 2.5-hour webinar by Larry Connors on how he used ChatGPT to develop a hedge fund. Curious if your firm is starting to use AI in developing strategies. Well, Bill, we've talked a lot about our global fund. The global fund was designed and developed around our strategy, but we're using a machine learning model to choose 40 strong relative strength global companies and 40 value companies out of a quality bucket. And we're rebalancing relative strength monthly, and we're rebalancing the value bucket quarterly over 12 quarters, because value takes about 3 years to express. And we're really pleased with the outcome so far over the first, as it's 15 months, portfolio's up just over 40%. So yeah, I think we have to be considering using these tools. And I think that it can give you making good decisions. Paul reads, if there's an end to hostilities in Europe, this should be positive for stocks. Which European fund stocks are under consideration? So in our macro portfolio, we own EZU ETF, which is the European Euro Stocks 50. We own EUFN, which is the European Financial Services ETF. And in our global fund, we own several European equities, which are certainly perking up, and it would be a positive if you could end the hostilities for sure. Moving through the list, I'm going to have to be a little bit choosy today because we're getting tight on time. Energy stocks in both US and Canada have lagged. Oil inventories are reported low. Do you think this is recession worries? I think, frankly, the weakness in Canadian large energy companies is more to do with concern around tariffs. There's been more weakness, for instance, in CNQ than there was in Suncor. Suncor has its own refining capacity. And we think that this is not going to be a long-term issue. You know, you own a resource company, ideally one with a lot of reserves in the ground, because sooner or later resource prices move higher and you get paid. In the meantime, you get a dividend and generally one that's growing, and we think that that's pretty attractive. We focused a little bit more on the natural gas stocks over the last little while. An anonymous question: as an individual investor, in your opinion, would buying gold, the metal, in Canadian dollars be a viable hedge against the risk of Canadian dollar being crushed by looming Trump tariffs? I have a 0% problem recommending people have a component of physical gold in their portfolios. And it's certainly one that we're looking at. We own gold shares, but you can buy the PHYS ETF, which is an ETF which owns physical gold. Even this week in the market sloppiness, gold stocks pulled back a little. The gold was rock solid. So yeah, I have no problem owning that as a hedge. I'd prefer to own gold as a hedge against risk currently than bonds. Bonds don't hedge us in the event of inflation, and gold does. Do you think Canadian banks can go lower after the earnings similar to JP Morgan? What's the outcome on the outlook for the Canadian banks and US banks? You know, I think that the outlook is strong. I think that this is a theme and a sector that is going to outperform for a long period of time. They benefit in the world that we're living in. Structurally, things are getting better for them. And there's always going to be news flow for sure over the next 4 years. There's going to be a lot of Trump bombs. But you have to consider the fact that these aren't just news-driven vehicles. They're businesses, and the businesses are thriving. And ultimately, you know, this is why we have such a big weight. We really like the dividends and dividend growth. I got a question from Derek asking about the VIX, which has increased a little over the last month. It's still right within the range that we would be typically in during a bull market. I think there are risks in this market. I think that the risks are in the crowded sectors. And frankly, we don't even have to say which ones those are. There are sectors that everybody owns and stocks that everybody owns that are underperforming the market currently. And while they can always get returned around as it stands right now, I think there's risk that money rotates within the market. I don't think money's leaving the market. Last couple of questions. Are you bullish on all precious metals, silver and platinum? Silver and gold, yes, both. Comment on the pullback JP Morgan to the 50-day moving average. Yep, you know, I mean, stocks are pulling back a little. And I would just say that, you know, the simplest measure of short-term trend is a 50-day moving average. And we love to see our companies trading above the 50-day moving average, and JP Morgan is trading above the 50-day. Couple more things. People are going to email questions. Great. Okay. I hope that that's useful. I really appreciate people taking the time to jump on. I'm going to jump off and head to a meeting. We look forward to seeing everybody again next week. We will be putting up on Twitter, and we will be sending out by email the link to the webcast next Wednesday on Music Fund. If you're interested, you want to learn a little bit more, please don't hesitate to jump on. You know, this is a sector that we've done a lot of work on over the last 7 years, and has been a great investment and is a great complement, not market sensitive, not economically sensitive, has some inflation protection built in, and generates great cash flow. So it's something that we're really focused on. And if I haven't answered your questions or the stuff you want to talk about, please reach out. I mean, that's what we do. We have 200 families we take care of. We got lots of time for all of them. And we want to answer whatever questions you have. So thanks for jumping on. We'll see you again next week.